BlackRock, the world's largest asset manager. A company that controls more money than most countries' entire economies. But with over 10 trillion in assets under management, is this financial giant's stock a good buy right now? Or is it already priced to perfection? Let's take a deeper look into its business, its financials, future outlook, and finally what might be a fair value for the stock. Overview. BlackRock, ticker BLK, is the largest asset management firm in the world. Founded in 1988, it started as a small fixed income firm but grew rapidly through acquisitions and innovation. Today it manages everything from equities and bonds to real estate, private credit, and alternative investments. But the real powerhouse behind BlackRock's success has been iShares, its ETF business, which is the largest in the world. iShares ETFs account for roughly 1/3 of BlackRock's total assets under management, AUM, and they generate a steady stream of fee income even during volatile markets. BlackRock also provides risk management and technology services through its Aladdin platform, used by banks, insurance companies, and other investment managers to monitor portfolios and manage risk. This gives BlackRock a tech-driven edge that traditional asset managers don't have. The business model is pretty straightforward. They earn fees based on the assets that they manage, typically a small percentage of AUM. So when markets rise, their revenue tends to rise too. But on the flip side, when the markets fall, so does their income. Financials. Let's start with some key numbers. BlackRock stock currently trades around $1,200 per share, giving the company a market cap roughly $180 billion. Looking at earnings, forward EPS is expected to be around $48, which means the stock trades at a forward PE ratio of about 24. That is slightly above the historical average, but in line with what investors are usually willing to pay for a dominant high-quality compounder like this. BlackRock also continues to return plenty of cash to shareholders. The company pays a dividend of roughly $20 per share, which equals a yield of around 1.8%. That might not sound high, but it's extremely reliable. BlackRock has raised its dividend every single year for more than a decade. The dividend has grown from about $6 in 2012 to over $20 today, nearly tripling in that time. And with a payout ratio of below 50%, there's plenty of room for continued growth. Little short interest. Now looking at the broader performance, EPS has grown from around $14 in 2012 to over 41 TTM today, a compound growth rate of around 10% per year. That's excellent consistency, especially for a company whose results are tied to the global market conditions. Revenue per share has shown similar progress, climbing from $53 in 2012 to roughly $140 TTM. BlackRock's businesses scale well. Even as the company grows larger, operating margins have remained remarkably stable. The operating margin has been hovering around 37%, right in line with the historical average. And throughout the market cycles, the company's profit margins has hovered in the 30 to 35% range. Long-term debt is just over $14 billion versus equity of more than $51 billion, showing a very healthy balance sheet and conservative leverage. BlackRock also remains a strong cash generator. Free cash flow per share has more than doubled in the last decade, from about $12 to over $25 today, easily covering dividend payments and giving the company flexibility for buybacks and strategic acquisitions. So financially, BlackRock checks nearly every box. Steady earnings growth, excellent margins, manageable debt, and consistent shareholder returns. Future. Let's start with the opportunities. First, ETF and index investing continues to be one of the biggest long-term trends in global finance. More investors, retail, institutional, and even governments are moving away from expensive active funds into low-cost index funds. And since BlackRock's iShares platforms dominates in this market, they are perfectly positioned to keep benefiting from the global shift. Second, there's Aladdin, BlackRock's powerful technology and risk management platform. It's used by banks, pension funds, and other asset managers to monitor portfolio and analyze risks. This business is incredibly sticky. Once clients adopt Aladdin, they rarely leave because the system becomes deeply embedded in their operations. However, it's worth noting that Aladdin's revenue is still small compared to the BlackRock's main asset management business. It's more of a high-margin, strategic side business rather than a major profit driver for now. But it does give the company valuable recurring revenue and strong client relationships. Third, BlackRock is expanding into alternative assets like private credit, infrastructure, and real estate. These areas typically generate higher management fees than ETFs, so they could help improve profitability and balance the company's exposure to traditional markets over time. And finally, the company's global reach is a big long-term advantage. BlackRock is growing fast in emerging markets, regions like Asia, Middle East, and Latin America, where wealth is increasing and institutional investing is still developing. Overall, the future looks solid. The company has multiple growth engines and unmatched global footprint. Risks. But no investment comes without risks. The biggest one for BlackRock is market dependency, because most of its income comes from management fees based on assets under management. Any big drop in global markets directly reduces their revenue. When investors pull money out during downturns, fees fall too. Then there's regulatory and public sentiment problem. BlackRock's size and influence have started to attract more scrutiny from governments and regulators. On top of that, there's growing negative public perception. Some people believe BlackRock controls everything, buys all the houses, and drives up prices. And to make things more confusing, many of these people confuse BlackRock with Blackstone, which is a completely different company. While most of these claims are exaggerated, they have still become popular talking points in political debates. And that matters, because if enough people believe them, politicians may take regulatory action just to gain public favor. Lastly, there's competition risk. Vanguard, Charles Schwab, and State Street are constantly lowering ETF fees, pushing the entire industry towards razor-thin margins. That makes it harder for BlackRock to maintain its profitability if price pressure continues. So while BlackRock remains one of the most dominant and well-managed financial companies in the world, it's not immune to market cycles, regulation, or reputation risks. Valuation. BlackRock's forward EPS sits around $48, and analysts expect it to grow roughly 12% per year over the next few years. The company itself is guiding for about 10% compound annual growth rate in revenue, which seems realistic given its scale and long-term trends. In my view, the big players in asset management are only going to get bigger. Money continues to concentrate into fewer hands, and the ETF boom shows no signs of slowing down. On top of that, BlackRock still has a huge growth potential outside the US, where passive investing is just starting to catch on. But to stay conservative, I'm assuming about 9% annual growth for the next 5 years, followed by 7% after that, which still feels very achievable for a company of this size. Historically, BlackRock's stock has traded anywhere between 17 and 13 times earnings, with the median around 19. So at the current forward PE ratio of roughly 24, it's trading a little above its long-term average. To me, this company feels very safe in the long run. It has an incredible track record, solid management, and a business model that's proven it can perform through multiple market cycles. Because of that, I believe it could reasonably trade around 22 PE a decade from now, which feels fair for a dominant high-quality compounder like this. But it also means investors shouldn't expect much multiple expansion from here. Most of the returns will likely come from earnings growth itself, not from the market assigning a higher valuation. I personally aim for a 12% annual returns on my investments. Plugging those assumptions into a simple valuation model gives me an intrinsic value of roughly $1,100 per share, which is actually right around where the stock trades today. For long-term investors looking for exposure to the asset management industry, BlackRock remains one of the safest and most dominant names out there. With incredible scale, diversified revenue streams, and very shareholder-friendly approach through steady dividends and buybacks. That said, the stock has traded at the lower PE ratios in the past, so this isn't a deep value setup. It's more of a quality at a fair price situation. Chances are that you won't gain any multiple expansion capital gains here. You usually see those superb returns when both businesses grow and the market gives you a higher multiple. If you bought it 6 months ago, you probably got a better deal. But even today, for patient long-term investors, BlackRock still looks like a solid buy. And of course, this is not financial advice. Always do your own research before investing. So that's the look at BlackRock, the king of global investing. It's not the cheapest stock out there, but it's one of those rare companies that can quietly compound wealth for decades through growth, dividends, and buybacks. Well, what do you think? Is BlackRock a buy, or is the PE ratio too high right now? Let me know in the comments. And don't forget to like, subscribe, and share if you enjoyed this video. And as always, do not lose money and safe travels. Bye bye.